You're thinking about doing Roth conversions, but you still have one question in your mind. We're married, but what if one of us outlives the other by a significant margin? Now, this is a real reality for many retirees. It could be a significant age gap between spouses. It also could be a very known health history that makes it more likely that one spouse outlives the other. Now, you may have heard the term widow's trap or widow's tax penalty. Today's video is going to show you and walk through how that potentially may or may not impact your ability to do Roth conversions, or even should you do Roth conversions. I'm going to make the argument here that there are some things that you should think about first before just doing a Roth conversion simply because one is left behind. And there's a couple levers that you may want to pull that you haven't thought about yet. If you're new to the channel, my name is Forrest Dutton. I am the owner of Brightworks Financial Planning. I'm a certified financial planner. I love doing these videos. They're meant to be educational only. They're not personal advice. They're not meant to be tax, investment, or any type of financial advice. They're just to help you retire with confidence. So let's get on to today's video. Okay, let's talk today about what's considered the Roth conversion widow's penalty. Now again, I'm going to break that up into two different things. It's not actually the Roth conversion widow's penalty, it's the widow's penalty and Roth conversions in light of that. So what is that problem defined? So essentially, our tax code is written such that it favors those that file married filing jointly. There's larger tax brackets for each bracket, and there's also a larger standard deduction. So what some couples do is as they're entering retirement, they're really concerned we have large balances in tax-deferred accounts that might trigger required minimum distributions that are large, and therefore if I leave that behind to one spouse, whether it's a combined amount or if it's one spouse has a larger IRA than the other, we're concerned that that widow will get penalized in the form of higher taxes later in life. And so this problem is often called the widow's problem. So you're left with money, you have to take out more money, you have more tax, which this impacts your cash flow in a negative way later in retirement. So in order to solve for that, sometimes clients look at, should we look at converting money early in retirement so that if one of us does pass before the other, we won't be so severely penalized and we will still have some control over how our income is distributed and therefore potentially pay lower tax. So converting to Roth is one way to mitigate that. Now, before we get into today's case, I also want to say that there's one other consideration when it comes to protecting a widow in retirement, and that's often around Social Security timing. You're going to see that in this case. What I've done is I basically have Joe and Victoria, and they both have decided to delay Social Security. Now, this is especially important if one spouse has a much higher earnings record and has a higher primary amount in terms of their full retirement age, their primary insurance amount at Social Security. If it's much higher, especially if that high earner thinks that they will not outlive the lower earner, a lot of times those couples decide to delay the higher earner's Social Security until 70. Reason being, they're earning delayed retirement credits from the age that they are at full retirement age to 70. For most people watching this, if you're born in 1960 and later, that's going to be age 67. So if you wait until 70, that can provide some income that's higher than it would have been for the spouse left behind. Now, that being said, I'm going to run that in the background of this case. But let's go ahead and get into this. So when it comes to the facts of this case, I have Joe and Victoria. They're both 63. And they're looking at, should we do Roth conversions? Let me tell you what they have. They have $500,000 in a taxable brokerage account. $250,000 of that is their money. $250,000 is growth. They both have $1.5 million in tax-deferred IRAs. So total, they have $3 million. They also, I'm assuming, a rate of return on accounts, 5% for the taxable, 6% for the IRA. They have nothing in Roth. So we're going to run Roth projections at a 6% return. I'm going to assume for this case that Joe is the one who thinks he's going to have a shorter life expectancy. Now, this could be because of age difference. Maybe Joe's significantly older than Victoria. Maybe Joe has some health conditions that are going to limit his life expectancy, or in his family, he knows some certain things run in his family, and he just wants to plan conservatively accordingly. So I'm going to have his life expectancy ending at 75, and we're going to start with Victoria's life expectancy at 90. So notice there's a 15-year gap there. And what I've done here is I've shown, to demonstrate this, Joe being the higher earner, he's going to have $42,000 starting at age 70 in income. That is from Social Security. Between age 63 and 70, they are not going to be working. They're just going to be doing portfolio withdrawals. However, Joe also does have an annuity that has 100% survivorship, and it's going to give him $18,000. And then, so far, if you're keeping track here, we've got $60,000 of guaranteed income starting at age 70. And then we're also going to add a spousal benefit. So this would be roughly half of Joe's benefit. So if we did $42,000, let's change this to $21,000. Just more accurate. So if you think here, we've basically got $42,000 plus $21,000 plus $18,000. So we've got over $80,000 of income that we want to live on starting at age 70. Now, that matches pretty closely to what their budget is. So what I've baked into this case is that they only actually need about $80,000. So when they get to age 70, most of their needs are going to be covered, but between 63 and 70, they need to take those portfolio withdrawals. So in this case, what would we do when it comes to Roth conversions? Now, as this is running in the background, I just want to remind you a couple things. When it comes to Roth conversions, I want you to think about directionality. Okay, so just to remind you, there's things that we can change that are going to drastically change a Roth conversion projection. One is, when does the widow's penalty start, right? Does it start at 75? Does it start at 70? What if it's even earlier? What if you retire at 63 and it's in the late 60s? All these things make a huge difference. So you don't actually know when this will happen, right? So most of the time, Roth conversions, all the facts cannot be known until after the case. So this can't be the only reason you do a Roth conversion. The other thing is, there are other things that are out of our control. What is the exact return on your investments? No one actually knows. You won't know until much later. Also, what are taxes going to do in the future? We don't know. So a lot of times, again, I like to think about directionality. What are the factors and the levers that you can pull that would make a Roth conversion make more sense or less sense in your case? So we've already gotten to that point, and we're just looking at some different factors when it comes to Roth conversions and widow's penalty. Let's take a look at our income and spending in the early years. And what I've done here is to show you base case. So remember, they need $80,000. Just like I said before, these early years, if they do nothing, base case means we're not doing Roth conversions. It's a comparison. So since they have $500,000 in a taxable brokerage, that's going to last them all these years I'm hovering over. So it won't be until 2032 or 6 years in that they will start running out and have to take out tax-deferred money. Now, in that case, you could see how they might be thinking about Roth conversions, because in that case, the tax-deferred money would just be growing. It's not being drawn upon. Now, we don't know what the next 5 or 6 years of returns would look like, but it's reasonable to assume once we get there, we're not really going to need much until we get to required minimum distribution age, which are these two bars that you see here, which is 2038 in this case. Now, what does Roth conversion, Roth case actually mean? So what I've done here is I've had them do a series of Roth conversions, and we're going to do these over a 10-year period. Now, what is our North Star in this case? Well, I'm just going to start showing you what it would look like if we did this at a certain bracket. So what you're going to see here is the green bracket and the dark bar represents the income in the Roth case. So I'll hover over it so you can see it. That's our Roth trajectory. It's pretty smooth, and these bars represent taxable income, ordinary income. Okay, so basically what we've done here is layering the bars over that. What we've done here is we've filled up the 12% bracket for 10 years. Okay, now I want to show you what that actually looks like. So just hovering over 1 year, the taxable income in that case is $100,800. That matches perfectly the top of that 12 bracket. That's what that's showing you. Okay, so basically over these 10 years, we have perfectly filled up the 12% bracket. And what that actually looks like down here is you can see those numbers. So roughly 120, 126, 141, 142, 149. Then it's going to drastically drop, and you might be going, wait, why? How come we're not doing as many conversions if it's the bracket? I think this should be a stepwise. Well, the answer is if you have taxable brokerage money, it makes your ability to do larger conversions more tax efficient, because remember, capital gains taxes and ordinary income taxes are two different things. So you're actually able to convert more and still stay in that marginal bracket if a large portion of your other money that you're living on comes strictly from capital gains, because some of those will be at 0, some will be at 15, but the actual marginal bracket of the conversions are larger here. So that shows kind of why that trajectory looks a little bit weird. And this is also showing you, again, in the Roth case, we're going to be living on taxable assets, and we're going to be converting the money here in this other color up top in this bar, right? So this again shows us, I've also modeled in here, it's not really a big part of this case, but in red I have QCDs. So I have Joe passing away in 75, so at age 74 and 75 he did some QCDs in red, so they're roughly $10,000 and $11,000. And then with Victoria being left behind, I have her doing QCDs the rest of her life, which is here. And I do have that in the Roth case as well. So what I want to show you then is, what is the value of actually doing that in terms of converting that? What's the directionality? Now, what I've done here is there's two different ways you can look at this. And I'm going to press a few buttons so you understand this. But basically what you can do is you can look at this in real dollars, which isn't as helpful. So this basically says if we converted over those 10 years prior to our RMD age, and we filled up the 12% bracket, the projected difference is $266,000. Now that sounds great, and you might want to say, sign me up, that's awesome. But in reality, that doesn't actually tell us the real value of what we did. So a better way to do this would be to think about what is the present value of this. So those dollars that we're going to pay Roth conversions over these 10 years, if we did nothing, they would just be compounding in some sort of investment account. So I've used the rate of return in the taxable investment account at 5%, and we discounted that number to present day. So what is the actual value? The actual present day value would be $20,000 of that decision. Now what you typically want to see is you want to see a positive present value. Now I'm going to show you in a minute how that can wildly swing depending on what your plan actually is. Now one thing you may have already noticed about this case, I don't know if you picked up on this or not, but this couple only needs $80,000 to live on. But let's do the math here. They have $3 million in tax-deferred assets. So to me, this is another directionality question. So if you truly have no needs, meaning we really don't want to spend $80,000, no, we don't want to go on another trip, no, we don't want to do anything else, 80 is literally all that we need and all that we would ever want, then this is a perfectly good scenario. But I want you to step back and think a little bit. Let's just use the 4% rule, right? So let's say you have $1 million and you're taking 4% a year, that's 40,000. So what is that on 3 million? It's 120,000. So another way to say this is, this couple, especially knowing that income is coming at age 70, is underspending. So in most cases, when you look at the widow's tax penalty and doing conversions at this level, meaning somewhere around this 3 million level, you're going to see that directionality is positive if you are underspending during those years to make room for those conversions. Now, my alternate argument is you could just spend more money. And if you spend more money, remember by definition, you're worried about these balances being too high when you get to be 75 and older. So instead of converting it and thinking your spouse is going to be gone, naturally, my thought is just spend more money. Spend $120,000. So what I'm going to do here is I'm just going to put 120 in here and just show you again, this isn't meant to be exact, but it's meant to show you that these things are based off of directionality, meaning, I want you to think through why we're doing what we're doing. So like it would make sense that you're going to see a less favorable position here in terms of the directionality of how the present value of these conversions, because you're spending more money, and by spending the money earlier, you're going to be preventing those balances from becoming so large that they're going to be cumbersome in terms of your required minimum distributions. So I'm running this here just to show you again, there's a lot of different ways you can look at this, but there's no one right way. There's so many different ways to think about this. Now notice, we flipped, I'm going to get out of this, so we just flipped from a positive net present value about 20,000 to negative, just from that one spending decision. Now I'm going to redo this in terms of the brackets just to make sure that we're on the same page and we're seeing the right thing. I don't think we're going to see a drastic change, but I always like to rerun this to do the 10-year projection just to make sure. So just to recap, all I've done here, I haven't changed anything about Social Security, haven't changed anything about age or longevity. All I'm changing is how much money they spend from the start of retirement, and that's at $120,000, and we're going to inflate that at a 3% rate throughout their entire retirement period. So there's not really a huge difference happening here besides the spending value. But the point of me doing this exercise is to show you that spending is a variable that can swing things one way or the other pretty strongly. And I'm also going to make the case that the other thing that you can that is going to swing this pretty far is the age, right? So what I've done here is, all I've done, remember, I went from 80,000 to 120,000 and I redid this. I redid the conversions. We did the same conversions over 10 years. And basically it's mildly negative, right? So it's still a negative present value. So this would maybe persuade you to say, well, it's kind of like the same if you do, the same if you don't. It's a better way for you to view this. A zero present value would literally be there's no difference. So we still have it's trending negative, right? So this may be something you want to consider. Now, the other thing I want to show you is when it comes to the potential impact of IRMAA brackets on your conversion decision, especially in this case. Remember, this couple is doing conversions over a 10-year period, which means they're 63 now, so everything they do is going to start impacting them when they become Medicare age at 65. As a reminder, IRMAA is income-related monthly adjustment amount. It basically means whatever your income was, modified adjusted gross income was 2 years ago, you're going to have a surcharge on your Medicare Part B premiums. So often when you do these, you may see a positive value in terms of the present value of IRMAA. So just visually what I'm showing you here, again, the numbers are not important, but what this is showing you is for a good number of years, when you notice that there's a sharp decrease in this graph, that is showing you the compression of tax brackets when you become single. So notice nothing has changed in terms of income one year to the other, or very little has changed, but all of a sudden you are in a much higher bracket just because you're single. That's what you're seeing from here down to here. So remember those IRMAA brackets also change drastically. So what we've done is, just to show you this, so just tier 1, what that's saying is that if your modified adjusted gross income is $330,000, you would then have a tier 1 charge of IRMAA. Now, these dollar amounts are going to be monthly. I'm not going to go through the exact numbers, but basically every month you pay your premium, you're going to pay an extra amount if you hit tier 1. And that means even if you go $1 above that tier, you are going to pay that the entire year. So notice that 330 for tier 1. What this is showing you is it's 170 if you're single, right? Makes sense. So again, it's roughly half. It's not exact, but roughly half. And this is projecting in the future. So if we look at actually this year, these are the accurate numbers for 2026. 231,000 for a couple married filing jointly. So the benefit here is if you do those conversions early, it does benefit you in terms of IRMAA on a present value basis, because later in life, again, assuming the spouse lives to 90, notice they make it all the way up to the 4th tier by the time their life expectancy is over. Whereas if we do Roth, we're only in the 3rd tier by the end of life. So you can see how that would be a net positive. Now, what you may want to do is do an analysis of both of these and think, well, one is slightly negative, one is positive. Well, that's a net positive. You could view it that way if you want. Depends on how important one is to you or the other, because when it does come to IRMAA, that is something that's going to impact you on a month-to-month basis. Now, taxes will as well, but sometimes taxes are just not viewed that way because you only pay them once a year. So I wanted to show you that, and I'm also going to show you, so I've showed you the impact on spending. I just want to do one more thing and show you the impact on life expectancy from both perspectives. So what I'm going to do here is we're not going to change anything. We're just going to change the life expectancy of the surviving spouse from 90 to 95. So we're also going to use this 120,000 spending, so I'm not changing that. The only thing we're changing is, again, the life expectancy of one spouse. Now again, just to underscore this is just directionality, right? We're only thinking, does it make more or less sense if we want to protect against this? This is almost like insurance. This is the, Roth conversion it's almost like an insurance for things that could happen. You don't actually know in most cases what your situation will be. In most cases, a lot of these things will fluctuate and they could change over time. So the last thing I want to say is, in my mind, another analogy for this could be Roth conversions are like refinancing a house when you don't know how long you're going to live there, right? When we're looking at people's ages, how long they're going to live, it's much easier to look at refinancing and paying some upfront costs when you know you're going to recoup those costs. We don't actually know that. So looking at this now, so again, big difference. If we went to age 95, even at 120,000 spending, right? Remember, that's the change we made. This ended up being a net present value for doing those conversions up to the 12% bracket. Now, given that some circumstances have changed, we could run this again and see if it's any better or worse if we change the bracket. Say we want to bump up another bracket in this case, we could do that. We could analyze that. There's no reason we can't. That's not really the point of this. I just wanted to show you how you should consider these matters when it comes to Roth conversions. And really, the other take home I want you to see is that a lot of times when you think about the widow's penalty, you're thinking, wow, how bad actually is this? In reality, it may or may not be as bad as you're thinking. So what I'm going to show you here is just a breakdown of if you had a widow's penalty happen in 2026. So this isn't exactly modeled off our case. This is going to be modeled closer to 2.5 million instead of 3 million, but I just want to give you a rough idea of what the tax penalty actually looks like. So what I have here is if someone were to pass away with an IRA and they have roughly 2.5 million in 2026, say that person is 75, they're going to have to divide that by 24.5. That's the required minimum distribution factor. So that means they would roughly have to take out $100,000. So whether they wanted to live on it or not, that would be the required minimum distribution. If you're married filing jointly, I have, prior to the person passing, they have $50,000 in social. If one person passes, they're only going to take the higher of the two. So I'm assuming this is a scenario where both of them actually have the same amount. They both have $25,000. So the widow is left with $25,000, so they have less to spend. What does that actually look from a tax perspective? You can see the standard is lower. You can see if they were older, then they were getting that additional senior deduction. So another way to say this would be 16,000, 16 versus 10, right? So another way to think about this would be, okay, I'm paying $6,000 more that year and every year ongoing, right? So if this happens at 75 and I live to 95, then you can just say, well, what's that times 20 years? Well, the answer is $120,000 roughly. So if we look at this, what's another way to view that on a present value basis? Well, there's a couple ways. If you don't want to do it with the fancy software, all you can do is say, well, what is the amount that I'm going to get at the end in terms of tax savings, meaning what did I get back by paying into these taxes, and what did I put in? So another way to look at this would be what I would call the quick and dirty way to look at this. This is just an old school present value analysis. So I took those Roth conversions that couple did, assuming this was 10 years earlier from 26. I'm jumping a little bit. But basically, if they paid this much in taxes, I just split the amount of money they paid in taxes. And I'm going to show you where I got these numbers really quick. So from here, in this scenario, just assuming this happened 10 years earlier. I'm just kind of jumping forward. So let's say that it was 530,000 in Roth conversions. Now in this case, I'm projecting about 1 million in Roth conversions, but I'll try to allow you to follow me here. Let's assume we did 1 million, because again, the numbers don't matter, the principles are what matter. This was from an earlier scenario where we hadn't changed some of the numbers, so the underlying assumptions changed a little bit. But let's just assume there was $1 million in Roth money converted, and with that million, these numbers represent how much you paid in tax that year. So this is a 10-year ledger of what you paid in taxes that year. Okay, so over those 10 years, that's what you paid in. For years that you see no difference or no benefit, you put a 0. This is the year that you're going to put in what was the actual amount that I received positively by doing the Roth conversion. So what I did was I took the difference between, I'll show you, this 6,000 number, and we just used a life expectancy. So instead of 16,685, I'm going to show you the exact number, 10,904. It's 5,781 times 20. Okay, that's how I got this number, because basically that's what you are actually benefiting. You're not having to pay that by paying all these Roth conversions. So this is a net present value. Basically, you put in some cash flows. What do you get back out? Is it positive, yes or no? Now you could argue and say, well, we don't really know what the discount should be on that. That's fine. But I was just showing you that this is another way, if you don't want to go through the full analysis piece, this is another way to really look at Roth conversions that makes a lot of sense to me. And basically the higher number this is, the more favorable this is going to be. So again, this assumes you live to 95. If you live to 100 though, then you would all of a sudden you'd have an extra 30,000. So this would go up to 140. And then again, you're very close depending on what you're using for your discount rate. So if that became 4, you're very close to break even. So it really just depends on how you want to view this. But I wanted to show you the actual impact, right? From 12% to 22% over a number of years. That's what the penalty could actually look like. Now the other argument too to be made here is, well, this 100 is only going to grow. That's fair. And could the brackets change? Yes, they could change. So you could be paying incrementally more over your lifetime, so that this number might be more than you think. It might, it could balloon to 150, whatever you think it's going to be. Then in that case, that's very positive in a net present value fashion. So just wanted to go through this, show you a couple different ways to look through it. Again, it's not meant to be specific advice for you, but I do think that there's something to be said for having a framework to view conversions through. Some of it's math, and definitely goes beyond the math. So I don't want to give the impression here that the math is really all that matters, because it's not. It absolutely is not. So what I would ask you though is, please show me what I missed. I'd love to know your comments. Please subscribe, like this video, share. I would love to know if this is helpful for you in how you're thinking through your own conversion decisions. That's ultimately why I'm doing these videos. It's not to bore you with math. It's not to make you get confused. It's to help you have more clarity on why you would do certain conversions and when, due to certain goals. So as always, education is my goal. This is not personal. If you need help with your personal situation, that is exactly what I do at Brightworks Financial Planning. You can reach out and visit my website to book a call, and I will see you on the next video.